Okay, a couple things I guess before we get started. We got to remember that tomorrow night, Wednesday at 7 o'clock, right here at your Armory Gymnasium, it is our lights wrestling against the dreaded Argonauts from Great Falls. So go and support your lights. That's always the, I don't know if you, would you call that the most important duel of the year? It's certainly the greatest rivalry, you know, that our wrestling squad has. So go and support your lights as they take on Great Falls, the dreaded Argonauts. And then Friday, our lights will be wrestling the University of Iowa, that's akin to having the University of Duke come and play our men's basketball team. So, I mean, the stature of the University of Iowa wrestling program is such that it would be that kind of a analogy, I guess. So, go and support your lights. What else is going on? Something else. I thought I forgot. How's that? I thought there was something else, but I must have forgotten. Anything else you guys know of? Any other events? Anything like that? Okay. It's Tuesday. Hope everybody got their assignments in that had to do assignments, except for Team Andrews, which of course was exempt last round. I don't know if Team Andrews will be exempt this particular round. So, David, you're shaking your head. Oh, by the way, I need to inform everybody that you might have to kind of pay attention to your competitors here. Some of them are so devious as to request that I process the round prior to everybody having a chance to actually get in their decisions. So, oops, I better, oh, I got it on play, okay. Huh?
Are you actually doing that?
Am I actually processing the round prior to? No. I said one of your one of your competitors got a little anxious and thought I should process the round on Sunday night or Monday morning, I guess it would have been, instead of waiting until Tuesday morning after the deadline, or at least Monday night after the deadline, which would be 9 o'clock Monday night. So you have that firmly now? Okay. So I did process the round already, so everybody knows, and we have the results. So it's not to keep everybody in suspense. We'll kind of go ahead and view those. You think you guys won?
No, God, no.
Baldwin? No?
No. No, you would.
Well, let's see. For earnings per share, Erie looks like they were the best team. For ROE, Erie once again had the highest ROE, which is amazing. They were definitely a long ways from the most sales. So, contribution margin, that solves some of that riddle maybe. Stock price. Big failure by Erie in cash flow. Strategy. So 99, just 1 point short of the perfection, but we don't know if they had any discounts. We'll see. None for emergency loan. We could see that up above. None for leverage, although I will tell you they were bumping up against the leverage. So, as was Team Digby, the computer team. Team Digby was actually closer. My threshold for leverage is 2.25 and Team Digby was 2.24. So you can't get any closer there, I don't think. No discounts, so winning team, Erie. Second place, the computer Team Digby. Third place, Team Chester. So let's go see what happened, shall we? Anybody got any ideas what happened? Erie is up here acting like the Broncos defense. You know, they're saying they killed it, that they absolutely dominated, all those other things. What do you guys think? Was everybody rooting for the Broncos? Really? Too bad. Sucks for you guys.
Either one.
You weren't rooting for either one? You know, and the advertisements were horrible too. I didn't see anything that was terribly exciting.
Were you watching on the Montana channel? Because I was, and we didn't
Yeah.
get all the commercials.
Huh. I don't know. It was a Montana channel, yeah, that we watched on, so.
BS.
Oh, well. The ones I saw weren't any good anyhow, so it didn't matter. The only one my wife kind of liked was the Doritos one. She thought that one was kind of cute. Yeah. Yeah. Okay. So let's take a look, see what happened. Oops, I got to go back. I'm sorry. It works better if I open this up in PDF. I can expand it a little bit more. Maybe. This thing was really running slow this morning, so. Maybe Capsim's getting hit big time today. Everybody else probably took yesterday off. Super Bowl Monday. Okay, here we go. How is it, if I left you just at this, I'm just going to ask a couple questions here. How is it that Chester could have a higher ROS but a lower ROE than Digby? What are things then that you know if you just see those two numbers? How can they have a higher ROS but a lower ROE? What's that mean? What's return on whatever? Jeez. Is it just because it's too early in the morning, or you guys want me to do all the teaching up here, or what? Spoon feed you? What's ROS?
Turn on sales.
Yeah, which is how do we calculate it?
Sales over net income.
Just the opposite. Net income over sales. Net income divided by sales. What's ROE? Return on equity. How do we calculate that? Net income divided by equity. So if I see that Team Chester had a higher ROS but a lower ROE, are there some assumptions that I can make there?
Stock, sold stock.
Maybe sold some stock, which would have done what? That would have actually increased their equity. So they might have done some things to have a higher equity. That's possible, given what we have. Okay. But there's other things they could have done to increase their equity. I mean, we're in a generalization, we can simply say that they might have higher equity. What would I say about their sales, though, and the fact that they have a higher return on sales? What did they do there?
They probably increased their variable costs.
Just the opposite.
Decrease their
Yeah.
variable costs.
They were more efficient, right? They were more efficient at generating income based on their sales, okay? So when you do see that number, and again, I've told you guys I'm not a huge fan of ROS, but it can, when I do some comparisons like this, I can come to some conclusions. And one, I can say Chester did a better job. They were more efficient and effective then. So that tells me, if I look down a little bit further, and you guys are probably looking at it, do you suppose they have a higher contribution margin or a lower contribution margin? Chester?
Lower.
It's you must think it's opposite day today. Are you a SpongeBob fan?
No.
Oh, my little guy grew up on SpongeBob, and he loved opposite day, I tell you. So they would have a higher contribution margin, right? Because they were more effective at generating income based on their sales, as compared to their sales, probably a better way to say that, right? So if I pop down here, I see that they had 34.8. Their SG&A to sales is fairly comparable to Digby, but quite a bit more on the contribution margin. Okay, so we can draw some conclusions again, just as we start at the top and we start kind of coming down here, and these things are kind of important. Asset turnover, we see the teams, Andrews, Chester, Digby, Erie, all had pretty good over one. Baldwin and Fair struggled a little bit with asset turnover. Okay, my guess is Yeah, if I'm just looking there, my guess is they didn't generate a lot of sales. I mean, that would be my first guess. I don't think that their assets are probably a heck of a lot different than the other teams, so my guess is they just didn't generate a lot of sales. ROA, Erie had and the best ROA, which is good. Just kind of glance and seeing if there's some stuff we can gather out of that. Not particular. The leverage in this particular report doesn't show it, but Digby was actually 2.24, so they were 0.01 from my threshold where they might have. I think mine's greater than, so they actually had 0.02% to play with maybe. ROE, look at that. Even though Digby had huge sales, what the heck's that, 60 million, 63 million more in sales, Erie was able to generate a far greater ROE. So again, we start to make some assumptions there. We can come up here and we can go to the return on sales, and we know that Erie was a lot more efficient and effective than generating income based on their sales. So that's a plus. So we can guess that it was probably contribution margin. They also combine that with a very efficient use of SG&A for their promotions. It's very efficient, very effective. 7.9% is getting pretty low to be able to generate. Did they have the second highest sales? Yeah, the second best sales, and be able to do that with just 7.9%. That's pretty good. That's pretty darn good. Okay. And obviously the contribution margin's the best. Just barely, they barely beat Andrews out for contribution margin. Okay, but they sure generated a lot more sales than did Andrews. And Andrews, 17.9%. So huge difference in terms of the efficiency or the effectiveness in terms of being able to generate sales. What's that? How they did that? And that ought to be your goal, is to figure out exactly how they did that, right? Okay, that ought to be every team's goal, is to try to, you may even want to look at Digby in terms of how they generated sales, right? But they didn't do as good a job of generating profit, okay? But if you could generate the kind of sales that Digby did and have the efficiency that Erie did, you'd be a dominant team, right? You guys are letting the computer team back in. I was pretty hyped up there after the first round because just beating the computer team in that first round was a good deal. But the computer team's kind of laying in the weeds a little bit, and it's got a big market share here. It might be able to turn some dials here, in terms of the profit and the efficiency and effectiveness. Sometimes you can do that when you generate the market share. That's Amazon's strategy, right? Anybody ever look at Amazon in terms of their income? They hardly generate any income. Okay, one of the biggest retailers in the world, and their income is almost nothing. Okay, in fact, there have been quarters in the last few years where they've shown no income. Okay, so what are they doing? They are plugging everything right back into the company. They're spending the money. They're just generating more sales. At some point in time, all analysts expect that at some point in time they're going to turn some dials. Okay, and then they will start to be more profitable. Turning dials means just maybe maintaining expenses in certain ways, right? Maybe not investing quite so much back into it for a particular quarter or year or whatever, doing those types of things. They turn those dials a little bit. If you're generating, and they don't generate this much, Walmart generates $500 billion a year in sales. If they can get a 1% increase in their margins, that's a chunk of change. That's like $5 billion, right? It's not chicken feed if you can generate 1%. And you guys will find that in this game too. Sometimes it's going to be 1% or so that separates winners from losers. Okay. Stock market summary. Interestingly too, looks like some of these other teams might have bought back some stock. I'm going to have to look. I can't remember exactly where they sat last round, but it'll tell us when we get to cash flow. Actually, it'll show us what happened there. But for sure, Erie bought back 100,000 shares. Okay, so they reduced the number of shares outstanding, which would do what to their earnings per share? All else being equal? it would increase their earnings per share. Should increase their ROE too, right? Should increase both of those. Okay, the two things that I score the highest on. Okay, because as an investor, that's my biggest concerns are those two things. Okay? Generally speaking. Stock price, nice increase, right, for Erie. Decent increases for a couple of these other teams. Andrews actually went downhill a little bit in terms of their stock price. Okay, not a bunch, but a little bit right there. Nice bump up there for Erie. So they were really laying in the weeds. They kind of ambushed you guys, is what it looks like, maybe. If we get a military analogy going.
It's like Erie really lowered their prices on their product.
Yeah, we'll see when we get down there. See if that's what helped them generate sales, maybe more so than investing in the marketing and those types of things. If they're reducing prices and using that as one of the factors, especially in certain key areas. Okay, so we take a look at that in the debt. Wow, look at that. Erie took on, it looks to me like $43 million in debt in the last in long-term debt. I don't even know what they did in short-term debt. We'll see, but they took on a ton of long-term debt. Okay, as did Team Digby, took on a lot of debt. Interesting, right? Especially given that they replaced 1 and 2. Okay, so they took on some debt. Not afraid of leverage. Remember, we talked about the leverage numbers up there, and they were both bumping right up against my threshold there for the leverage. So pushing it, and yet able to keep it just underneath. That might be as much luck as skill that they were able to keep it just underneath. Oh, Garrett, it was perfect. You guys had that just figured right down to the wire, right?
It's a complex formula.
It's a complex formula. Who devised it then? You guys got somebody coming in helping you? Must be. Okay. Net income. 4 of the 6 teams showed a nice net income. We're seeing some depreciation, a big depreciation by Erie, more so than Digby. Okay, so we got to assume then that. Ooh, look at Digby! Wow, I'll bet you Digby's depreciation next year is going to go up higher than Erie's. Look at that, $48 million in investment. Erie, $21 million in investment, but Digby's going to be investing twice as much. So, watch out. Again, we might see some things coming down the line there. But at least this round, Erie had more depreciation, so probably because of other investments. And Erie maybe has invested right along more so than Digby's doing a big chunk right here. We'll see what happens. Inventory, cash-wise with inventory, we see Ferris, Chester, and Baldwin all probably had some serious concerns with inventory, okay, because their cash decreased because of the inventory. So they probably had increases in inventory. Andrews to a lesser extent. Digby and Erie both kind of went the other way, so they actually reduced their inventories, which was a net benefit to their cash position. Right, plant improvements. Andrews and Chester, interestingly, how come we have positives there? What'd they do? Sold capacity then, yeah. Yeah, they had to sell capacity in order to generate that. That's the only way really you can do that in plant improvements. As you sell capacity, actually at a capital gain, so for more than what you have invested in. Dividends paid. Ooh, Andrews and Chester paid pretty good size. Andrews paid good size dividend. Chester a little less. Sale of common stock. You still see Baldwin sold a little bit. Chester sold quite a chunk. I thought some teams maybe bought some back, and they did. Both Andrews and Erie bought back some stock. So Andrews spent about $7 million, Erie about half that in terms of buying back some stock. Long-term debt issued. Digby issued a lot of debt. Erie did this time. So they must have had a bigger debt issue last round. The $35 million must have been last round, $8 million this round. Digby $19 million this round, so not afraid of a little bit of debt. Retired some current debt, and the only team, Digby, so in addition to issuing $19 million in long-term debt, also issued $37 million in short-term debt. Now the stupidity of that is that they have $64 million in cash. Okay, so that's not good cash management by Digby. Okay. Might be one of the reasons they lost out. Here's a good question. I've asked this one before of classes, right? So what would have happened? Digby's got $60 million more in cash than Team Erie. What if they had the same amount of cash? take 60 million from Digby's cash, would that do anything to their earnings per share? No, not really. I mean, we could sharpen our pencil and say you'd have interest or this or that or the other thing, but that'd be pretty insignificant. What would it do to their ROE? Let's say they just paid that all out in special dividend, 60 million in a dividend. What would that do to their ROE? That'll be a good question for your assignment. By the end of class, by the end of the semester, we'll hopefully be able to calculate that. Not just tell me what it's going to do, but actually sit down then and put the pencil to it and tell me what the effect is in terms of changing its ROE, say. Current assets in Digby, huge there, mainly because of the 60 million that they have in cash. You know, Erie, 33.2 million. That's almost perfect, right? I mean, that's cutting it kind of close, but you got a smidge of a cushion there. Okay, cutting it kind of close, but not bad, right? Chester's not bad. Andrews isn't bad either. You know, it's a little more cushion, but you know, that's probably what they were shooting for. My guess is that Erie was probably shooting for a little higher cushion and came up just shooting for 4 million. Yeah, see there, you only had 3.2. Yeah. Okay. Inventory, we were right. You know, Baldwin, Chester had inventory problems, as did Ferris. Plant and equipment. Again, Erie's huge. We saw that Digby invested 48, they invested 20. You know, if you just straight numbers, they're going to be about equal then next round in terms of their total plant and equipment. Okay. But interestingly, right, even though Erie has more plant and equipment, they actually have less equity. Okay. So a little bit of that's financial management there, right? Again, why did they have a higher return on equity? Because they have lower equity, right? They did earn more. They were also more efficient. Did a few other things, but one of the other reasons is they also had a lower amount of equity outstanding, and so it both factors. Higher on the numerator, lower on the denominator. Guess what? You're gonna have a better outcome. You guys all look like you're happy. You guys still suffering from a Super Bowl hangover or something? You're just half asleep today. Maybe 3/4 asleep today. Holy cow.
Only 1 cup of coffee.
Only 1 cup of coffee. Yeah, you got to get up earlier. You know, you got to get that second cup of coffee by the time you hit here, I would hope. You know, we're gonna have to start giving it to you guys intravenously in some fashion. Maybe we could get. They're gonna start a new phlebotomy program here, so maybe while they're doing that, they could put the little stent in or whatever, or shunt, I guess that would be called, and start delivering you guys coffee intravenously. Maybe just straight caffeine or espresso or something. I don't know. Okay. It's a beautiful morning out too. It's gorgeous. 35 degrees. No wind really. Sun was coming up.
Birds are singing.
Birds are chirping a little bit. I'm a little worried that the trees are going to start budding though. It's nice as it is. And then we'll get a freeze and then we won't have any leaves this summer. Anyhow. Income statement. Again, Digby, look at that. You know, 63 million more in sales. Variable costs. Yeah, 40 million more. No, about 60 million more there too, right? Sorry, be 60 million more. Again, the absolute dollar amounts there don't matter, right? What matters is the ratio up here as represented by the contribution margin. Okay, the variable cost number is just the inverse of this, right? So Digby's variable costs are 70.3%, and Erie's variable costs are 61.3%. Okay, that's all this number is telling you. And it's more important to know what the percentage is than it is the absolute dollar amount. Okay. Depreciation we saw. SG&A, we saw how efficient they were. You know, they spent only 15 million, you know, similar to Chester, a little more than Baldwin and Ferris, quite a bit less than Andrews, right? But they generated a decent amount of sales, okay, even though they spent so little. Hopefully we can go and figure out why. Other fees, write-offs, TQMs, bonuses, those types of things. We'll see that next round probably come into play a little bit more. EBIT, earnings before interest and taxes. Again, Erie had already gained an advantage there. Interest. You see the Digby and Erie big teams in terms of their interest. Ferris has a lot of interest, and so does Baldwin. Why do they pay in a lot of interest? Emergency loans, yeah, killed those two. Taxes, net profit, okay. Still lots of capacity. Still all kinds of capacity. But you will see two teams have used a decent amount of their capacity. And it might not surprise you if you know, when you determine that those two teams are first and second place for this particular round, right? So using capacity. Capacity is expensive, okay? You're paying for it. You're not seeing it really, but you should be seeing it in depreciation. You should be seeing it in interest expense. It's expensive in a lot of different ways that unless you really sit down and put a pencil to it, you don't see it, okay? You do see the cost of your second shift, right? Overtime. And so sometimes that scares you off. And that's kind of obvious that it must be scaring some folks off because there's all kinds of capacity still, right? Oh, okay, what do we got going on here? What'd you say, David, that you thought the prices were a big deal? Was that for Digby or for Erie?
For Erie.
25 on the traditional. Ferris had a lower price on the traditional, but Erie had the next lowest, and they sold a lot. They still have quite a bit in inventory. One thing to be concerned about next round: how much inventory does everybody have in the traditional segment? I mean, if you just do the math kind of roughly in your head. 24, 25. Good question, too. I like to ask. Okay, given.
Their material costs are pretty low too for.
Yeah, let's go back though. How much inventory is there in the traditional segment, roughly? Don't have to give me the exact. Just kind of eyeball that and tell me. A little over 3,000, yeah, 3,100, something like that, maybe in total units, or 3.1 million if you add the zeros. Yeah, that's a lot of inventory in the traditional segment. Okay, remember that's going to be there when you guys start next round. That there's teams that have inventory in the traditional segment. They're going to want to be selling that, right? And it will sell. Okay, but that's a lot of inventory. So, okay. Some other segments have quite a bit of inventory as well. Okay, but not quite that much. And that traditional looks like it's pretty heavy. Performance got some. Okay, so what were you saying there about material costs? In their
Like Erie's low was like $5.79 for material costs. That's not as low as
that's pretty equal, right? You guys have the highest material cost. Okay, where am I gonna be able to see that? Can I see that visually someplace? Probably. Although in their case, probably not. Okay, why is their material cost so high? That's a better question. Why is Andrew's material cost so high? Can you guys tell just by looking at that? Just looking at this chart. Why is Andrew's material cost so high?
Because of their MTBF.
MTBF, yeah. What's their MTBF at? 17,000. Everybody else at 14. Is Digby even at 14? Yeah. That kind of surprises me. Okay, so they've got a lot higher MTBF. If we look at and we'll look at that when we get down there, but when we look at the perceptual map, they may also be further out ahead. Maybe they moved it ahead. I don't know. That could be another thing that would lead to higher material costs, right? As you make a better product and you move it a little head down in the, perceptual map, moving it lower and to the right, you might have some higher costs in as well. But in this case, it's pretty obvious that that contributes greatly to their costs, right? Quite a bit more. I mean, that's $1 something per unit, and you're selling 1.8 million, so that cost them a couple $1 million, in terms of moving that MTBF. They sold out, but were they the highest sellers? Not even close. Erie sold 3.5 million in the low end, and they had a 14,000 on their MTBF. Price-wise was different, so too. I mean, quite a bit of difference there, because everybody's pretty much at 20 except for Andrews. We'll see though. They might have, had some more potential because they did sell out. Most every team sold out. Baldwin's the only team that didn't sell out, and they had problems with their low end from the start, and so they're trying to recuperate there, and that's hurt them obviously some. So, going to still have a decent amount of inventory coming in the next round. See, maybe they'll get positioned where they can do something with that. We'll see. Yeah, so what, you gotta come over here and take a look here, because I know we've had some teams investing. Where did Digby invest their money this time? 40-some million in plant improvements. They've bumped up some capacities. They got the highest sales, right? They're bumping up capacities. What do you guys think they're doing? What do you think they're going to be trying to do?
Build a new product?
Well, they already built one new product. I don't see another one coming in yet. But more generally, they're going to push for market share. Okay, so again, we might be able to kind of guess at what they're doing. We should be able to guess pretty strongly at what they might be doing for their strategy. They're pushing for market share. Looks like they've invested some money here in automation. Okay. Not as much as like Team Erie has in these three areas, but they've invested some money in automation. Okay. Baldwin's invested some money in automation here. Look at that. Again, unfortunately, because they started out of the in the hole with their low end product, but they've got their labor cost down to $1.23 per unit. $1.23 per unit. If they can get that one out of the hole, their costs on. Yeah, they're going to be a real low cost. $4 on that. That may go up if they have to push their product forward a little bit. Their material costs may go up, but that labor cost they might be able to get that down even further, believe it or not. So we'll see. Okay, that's pretty cheap. You compare that to $6.71, $5.71, $6, $6, and $7.77. Wow. Part of the reason there, though, too, is that they didn't make much, and so they're not using a second shift. So that may go up if they have to start doing a second shift. Okay, that will go up in terms of their dollars. So, okay. Oh, let's see. Looking at other reasons. So why did Digby sell so much? Because they had the high sales. Pricing looks, kind of right in there? Decent, but nothing spectacular.
They have 2 products in the performance section.
So they had good sales in the performance because they sold $1 million there and $300,000 there, having the 2 products. They probably didn't have to spend a lot on Doom because this was its first year, and they'll tend to sell pretty aggressively just because they're new. It's the old Apple effect, I guess, the new iPhone effect, whatever you want to call it. Okay, so that certainly would have been part of it. Okay, did they dominate in the performance segment? Oh yeah, huge, right? Huge domination in that segment. They sold twice as much in that segment if you combine the 2 products. Maybe, yeah, twice as much. As everybody. So they really dominated there. Looks like they also kind of dominated in the size segment. Huge. Again, twice as much, easily twice as much as any other. So they're really dominating up in the size and the performance segments. High end, not quite the domination, but they certainly sold more than any other team in the high end. Okay, so they're you know, while they're investing some money over here that might make you think they're a cost reducer, it looks like their main sales are coming from the high performance and size, so the high ends. We'll see when we get down to the perceptual map, give us a little better idea. Again, they're not mutually exclusive. Okay, just because a team and I don't know what their I can look it up, but I don't know off the top of my head what their strategy is, and I wouldn't tell you guys anyhow. But just because, let's say they're a broad differentiator, and they might be, that doesn't mean that you don't try to cut your costs, right? Okay, you still work really, really hard at trying to cut your costs. So even though you're a broad differentiator, you do those things first. Okay, you guys got to prioritize based on your strategy. So you always, if you're a broad differentiator, you're always pushing to make sure your products are as far forward as you can get them. Okay, generally, at least in those three high-end categories, high-end segments. Okay, that's got to be your first thing. Okay, you got to spend a little bit of money on marketing and sales. That's got to be maybe one of the next things, right? You got to make sure the other customer buying criteria are being met, age and those types of things, right? Those are really important. Okay, when you get all those done, you can still look at cutting costs, right? Especially if you got $63 million. You know, okay, they can either cut costs or they could pay a dividend. They could buy back stock. They could do all those things. Okay, so why else might they have had good sales? Their traditional product was tied for, Andrews had the highest price on there, but their traditional product was the next highest, and yet they sold more than everybody but Erie in the traditional segment. We'll go through, maybe we'll go down and look at these segment by segment. Might be a little easier. Okay, so Digby had the greatest sales, best sales in the traditional segment. Ooh, what do you see right away looking at the perceptual map? There's a little one there. Digby's out in front, aren't they? Okay. They're maybe closer to the ideal position. My guess is they're a little bit ahead of the ideal position. That's fine. 7.1, 12.9, 7.5, so a little better, right, on the performance size. And 12.6, so a little bit smaller on the size. So they're just a little bit out in front of where you want to be. Okay. But what else then? How about age? Yeah, that's a big deal. Okay, they're 1.6. That was their age at the end of the year. Okay, so they had a revision back in August. EAT's revision was in April, so EAT was a little bit older at the end of the year than was Days. You know, they were probably competing pretty straight up. EAT, though, had a much lower price, right? A lot lower price. So EAT, even with that much lower price, wasn't able to generate the kind of sales that Digby did. So how come Digby generated more sales? Well, their ideal age might have been a little bit closer. I would guess that they were just a little over 2 years old when they hit their revision date, and then it went back to 1 point something, and then it ended up being 1.6, right? Price would have to go to EAT. Ideal position, though, we got to give that to Days. And there's not a lot of difference there, right, between price and ideal position. So even though Erie certainly had the edge on price, Days certainly had the edge on position, and maybe by a bigger margin. Right, because Erie's way back here, it looks like someplace, right? Their EAT product. Is that you guys right back there? Yeah. Yeah. Okay. So Days had a little bigger edge there. And then we can look at what they spent too on budgeting. That might make a difference. Yeah, it's pretty close overall. You know, versus promos and sales. You could argue one's more important than the other. Pretty close. Okay. And their sales weren't. I mean, they were. What, 3% off? It looks like a couple percent off. Okay, but that's what differentiated between the two of them. Low end. And remember, okay, here's a good question for next week. I got to remember I should write this down. So how much inventory did we have? About 3,000, 3.1 million, okay, call it that. And the demand for the traditional segment this year was about 9.6 million. What's the demand going to be for next? It's going to be 9% more than that, so whatever, do the math, okay, that's fine. 10 something, okay. But there's 3 million in inventory, right? So what do we need to make as a group? I know you guys don't put your heads together and talk about that, right? Or at least you shouldn't be. But if you did that math, you know, what would you need to make as a group in order to fulfill demand next round? Yeah, maybe in that neighborhood, you know. That ought to give you a pause when you're going through your production then, right? Okay. First, know where your product's at, know what it's going to sell, you know, how much market share you think you can get, and then maybe use that number. Low end. Erie dominated in the low end. What's the most important thing there? Price. Let's see if Erie had the lowest price. Pretty much. Okay, tied for feet, which was kind of way down here, but they had the lowest price. Sold 3.5 million units. Age was perfect. Age was a big deal. Not perfect, but close. Okay, really during the course of the year, it should have been about perfect. Okay, should have been about perfect because it would have crossed through that 7-year-old during the course of the year. Location, not too big of a deal here, and pretty even with the top 3 sellers. Okay. MTBF. Because their age is only 4.5, another reason why Andrews had a higher material cost, right? I can't separate where they're at in there, but it looks like they moved a little bit, but not a ton. You know, these are still inside the inner circle. You know, probably still going to do okay. See, at some point in time, when they get back to where bead's at, you know, then you start to be a little bit concerned about their ability to sell. That's what happened here with bead. What'd you guys have in? What was your guys'? I gotta see. Sorry. Low end, Erie had a 40% contribution margin, and that's using 94% overtime. So they're still able to generate a really high contribution margin in the low end. Lowest price, okay, and still a very nice contribution margin. They weren't the highest contribution margin, but they were close. Digby actually had a little higher contribution margin in the low end. Okay. But they actually used 100% too, so they even used more overtime than did Erie, and were still able to generate a higher contribution margin. They've got a little less automation. Ooh. Where'd they generate the higher contribution margin? Price. Just be they were $1 more, so that's what would have given them the edge there. We're seeing pretty even here, right, in terms of the, you know, nobody's really gaining a lot in terms of the potential versus actual. Same thing here, but Digby dominated here in the high end. Again, we talked about Digby dominated high performance size. We saw that up above, so we're going to see that. You know, we'll probably see something similar here, right? Boom, yeah. So real domination here in the high ends. How are they doing that? We'll kind of skim over this a little bit, but right out in front, okay, they're getting their product right out in front there. Almost impossible. Okay, almost, and I'll say almost because there are some things that you might be able to do next round in particular, but to catch up. Okay, almost impossible at this point to catch up in terms of positioning. Echo could, maybe, but it'd be tough. Okay, it'd be really tough because you can only move it out so far, right? You can only push it so far and keep it within that next year in terms of its revision date. And you start getting too aggressive, you're going to get out past that year, and then you're going to screw everything up. Okay, and so they're well positioned, really well positioned, and there's competitors in that segment, but what's the most important thing? Ideal position. Okay, and they're well positioned, obviously, for that. Age next most important. I'll bet you their age is nice and low, probably the lowest. Yeah. Okay. they get up their prices and they still outsell. Okay, big time. Just because they got prices of little concern here, right? So if they want to really push their margins there, and they should, I don't know if the computer team will do that, but the computer team should be pushing their margins here, and because they're perfectly, they're perfectly positioned, and they don't have any competitors there. Like I said, you guys might be able to push a little bit in terms of the positioning, but might not be able to catch up to them. And I think we'd see the same as we come through here, right? Look at that. They got both of their products right there at the front edge. Couple products pushing them. Looks like Erie's product and Chester's product, probably pushing them right there. Okay. It doesn't. When I say you can't catch up, it doesn't mean you can't sell a lot of product in that segment, though. But you need to adjust then. If you can't beat them in terms of the positioning, what else can you do, right? That's the question you need to be asking yourself, right? We can't catch them in terms of positioning over the next couple rounds. If we were in the competitive rounds, I'd be a little more optimistic for you, because you'd have 4 or 5 rounds to maybe push it and try to catch up to them. But in this case, in a couple rounds, you're going to have a really difficult time catching up to them. That doesn't mean you can't sell a lot of product in that segment, right? But you're just going to have to adjust a little bit, how you go about doing that. And pretty much, same story, broken record here for size. Okay, we've let the computer team get up here and dominate in the size segment. Okay. Performance and size especially. All right, look at that. I mean, that's domination. That's like the Broncos defense right there. Okay, just complete domination. Right, Garrett? Can you say Von Miller? Tony, our Chester guy, he's a good Broncos fan, so he's enjoying that, I'm sure. He said it was a tough crowd. He kind of heard you guys the one time. You were giving me grief before the Super Bowl. So. Not a lot of difference, right? We didn't have a lot of difference in the potential and actual. About the biggest one was here, probably in the size segment. Okay, doesn't mean I wouldn't ask a question about it. They had even more potential, even though they dominated. Digby had even more potential than actual. They could have sold about 5% more, it looks like. So wouldn't have been enough to catch up to Team Erie, I don't think, profit-wise. There's a bigger perceptual map. This gives us a little clearer understanding. Okay, what's Digby's strategy? Computer team, what's their strategy? It's a differentiator for sure, yeah. And it's not a niche differentiator. I can rule that out for sure. Okay, and the reason I can do that is because if they were a niche differentiator, they'd be letting this one slide, the traditional segment. They'd only be concerned about these 3, but they're pushing their traditional product as well. And so they're either a broad differentiator or a life cycle differentiator. I can go with broad, because life cycle, they'd probably be letting their high-end one go down too, and they'd be introducing a new product there, I think. Okay. Can you tell what some of the other teams' strategies are? Maybe I should take points off for the other team. It's a little less easy to tell. Not precisely. If you combined it with some of the information up on top, then you could. You should be able to make some conclusions about what the other teams are doing a little bit in terms of their strategy. And that's important to know, okay, what their strategies are. Saw some nice investments here, okay, in the HR. And we see Andrews and Baldwin gaining 6% productivity. Not so much so for Ferris. Decent for Chester and Digby. Erie, not so much. Again, that's going to be 6% per year. Okay, in your you probably got $30 or $40 million in terms of HR costs. And that's going to be a pretty direct number. So investment there, may end up paying off reasonably well. One of the reasons Baldwin had such a low labor cost again on their low end product, right? Because they've invested here in the HR and getting a lot more productivity out of it. Go ahead.
Why would you invest in productivity if you still have high capacity?
Why would you invest in productivity if you still have high capacity? Because you can make more products with less people. Okay, the capacity is what the machines will make, right, in a given day or a given week or given month. But if you've got high productivity, that means that you can make the same amount of products, because you can only max out at the capacity that you have. You can make the same amount of products with fewer people. Save money, right? Labor cost. Okay, labor cost. You fire some people, sorry, they're gonna have to go find other jobs, but that's the world. I had a gal, what was her name? Tara? Is it Tara Taborski out of Malta? She was playing one of the first years that I had this game. We were playing it, and she was really getting into the cutting the cost. She was doing her team, I should say, but she was kind of leader of the team. And it was her response, that's why I remember her being the one. But at the end, when she really had a chance to stick it to some of the other teams, in terms of lowering the cost, she didn't. And I said, well, what'd you do? And she goes, well, I just didn't want to lay all those people off. I said, it's a game. And she just wouldn't do it. She said, no, I just can't do it. I can't lay those. I can't make that next decision, to really lay those people off. And so she didn't lay the people off, I guess. So speaking of which, did you see in the news, BGEN's laying off people in Glasgow? I saw just a little bit lesser, fewer oil trains coming through, obviously, and not so many wheat and other trains as well. So I haven't heard of layoffs here in Havers. Anybody heard? I got some buddies too that are on the railroad, and they never mentioned anything, but I didn't ask either. But it wouldn't surprise me that things are slowing down enough that they're probably furloughing at least. I don't know, laying off might have been the wrong word. Furlough is probably a better word. So. TQM starts next round. Okay, TQM, pay a close attention when you make those decisions. That's one of those cases where the little red triangle will be up in those boxes. And it'll give you some ideas about what those investments are and what's an optimum investment and those types of things. Pay really close attention to those as you make your decisions in that area. The other thing TQM does the what if for you right on the same page. As you invest money in that, it's going to tell you right down here. You'll invest money, say, this may be completely wrong, but in quality initiative training, boom, that may lower your labor cost by 3%, and that'll show up as soon as you mark out your investment here. Let's say it's $1 million, just again throwing out numbers. You might save 3% in labor cost, and it'll show you that right away. Okay. TQM, keep in mind though, TQM is different than equipment investment, say, because when you invest in equipment, you're trading one asset for another, trading cash for equipment, right? When you invest in TQM, it's an expense. Okay. What do I mean by that? If we come back up here to the income statement, others, fees, write-offs, TQM, okay, that's where that's going to show up. That's why I've said kind of as we've gone along, we're going to start seeing some amounts in there, and that'll be a direct expense. Okay, your equipment, when you invested in equipment, you started depreciating it, maybe you had to pay a little interest too, maybe not, okay, and so it increased your cost marginally. But TQM is going to be a direct cost. Now, keep in mind that cost is offset by, I got to always point these things out too, sorry. The cost is offset by, not too far, your reductions. If you save 5% on your labor, you might so you might invest let's say $1.5 million up here, and you might save 0.5% on your labor, which might be $500,000 in the first year. So yeah, you spend $1.5 million, but you save $500,000. Keep in mind too that $1.5 million is what in terms of your income statement. If it's an expense, it also means that it's what for you accounting types of people. Anything that's an expense, you get to write it off on your taxes. Yeah, so it's tax deductible. Okay, and so you get those advantages back. Okay, And so if you put a sharp pencil to it, you know, there's going to be an expense up front, don't get me wrong, but there's going to be some offsets in the first year. And any of these, if you're going to save 3% in labor cost, that's for the rest of the game. Okay? It's not going to matter as much, admittedly, it's not going to matter as much here in the practice rounds, because in the practice rounds you're only going to have the 4th round and the 5th round where you're going to see the benefits of TQM. When we get to the competitive rounds, then you're going to have rounds 4 through 8. So you'll have 5 rounds where it'll be a little bit more meaningful. So, okay, so do some messing around with that when you make your decisions. You want to spend some time on that and see what the importance of that is. Okay. Okay. Anybody else got anything? I didn't go over homework, did I? You guys want me to wait and do that on Thursday? It is autocratic. I can do it whenever I want to. So let's take a look at it. I'm going to bring up round 2 on here. Okay, first question. Why was Digby more efficient and effective with its SG&A? A comparison I said with Andrews might be valuable. I broke it down by segment. I said in the traditional, simply age, price, position, MTBF, all of them. Right? It had better, as good at least, as everybody else in terms of that, right? In the low end, it had age, price, and then in that case, they took advantage of Erie's lack of production, right? Erie had much higher potential and had a lack of production, and so they were able to take advantage of that. In the high end, it was mainly position, and again, we talked about this in round 3, right? Position, position, position in terms of those high ends because those were important. Age also came into effect here in the performance and size categories. Okay. So marketing is extremely important, and spending money on marketing and doing so wisely is important, but you'll make that spending more efficient and more effective if you pay really good attention to the customer buying criteria. Okay? And again, even if you're a low end or a low cost provider, that doesn't mean, especially in the high ends, that you can't try to push those products. Okay, if you're a low niche, right, then you shouldn't be spending a lot of time and effort in those high ends. You may want to even get rid of those products over time. But if you're a broad low cost, you're investing money first to try to save your costs then. But somewhere down 3rd or 4th, you should be spending money to try to improve those products and keep them competitive and relevant. Number 2, in the low end, Erie missed out on how many unit sales? Okay, 29.5% minus 22.8%. I got that from down below. I wanted precise numbers here, so hopefully you didn't just look at the graph. So 6.7% is what they missed out on. The total unit sales for the low end were 11,179,000 times 6.7% means that they missed out on 749,000. And you may have kept going beyond the comma, I guess, in that case, and that's fine if you did. So
What we did is we went our potential sales minus our actual sales. We got 860. Why is that?
That's what I did too. So,
potential sales minus your actual sales.
Yeah.
So you took the 29.5% times 11,179, and then you took the 22.8% times.
Well, we just took our potential sales or our actual sales number and our potential sales number, I think.
Oh, what you actually sold. Did you sell though some other products from other segments in that?
I have to look back at it.
Okay, because that might screw up that equation a little bit. So let's go look. Okay, so and we were talking in the low end here.
Yeah.
Okay. So in the low end, your actual sales were 2.2 plus 354.
Right, so 2191.84.
So 2.4, 2.54, 550, 2.550 looks like. Am I adding that right? So we got 2196 plus 354. So that was your actual. And your potential then should have been 29.5%, 0.295 times 11,179. So 3,300 minus 2,550. So it should have come out maybe 748. I might have been off one. Probably some rounding in there. Okay. Did you forget the other product?
Yeah.
Okay. Yep. If you got to remember, you might have more than one product selling in a segment. Okay. And so in that case, I was asking you just to look at the overall amount, okay, which was important. I'll ask you some questions in the future where you're going to break it down, maybe, where you will have, so many of one product that sells, boom, versus the potential, so many of the other product versus the potential. In this case, for example, let's go take a look. If I come down in the low end for Erie, okay, their ebb product their EAT product, which would be their traditional product, had a 3.2% market potential and a 2.2% actual, right? So it could have sold 1% more of EAT, and it went the other way. I'm sorry. I had it backwards. Its potential of EAT was 2.2%, and it actually sold 3.2%. Its potential for its low-end product, ebb, was 27.3, and it actually sold only 19.6. So the one actually offset a little bit of the other. Does that make sense? And that's why you ended up coming up with the different answer. But in the future, yeah, I might ask you some questions where you'd want to take a look at both of those. In this case, I asked you just to take a look at the overall, which is 29.5 minus 22.8 in the low end. Make sense? Okay. What are beads? Why are beads material costs so low? And positioning, and we kind of talked about that today actually. Positioning and cheaper materials required to make products so far back. Okay, so it's sitting way up there, right? If you look at the map. Digby invested about $22.5 million in plant improvements. What were those improvements? You might have had to go back and look at round one. You should have. They bought 50 units of capacity in the low performance and size. Actually sold, so an offset, dropped to 200 units of capacity in the traditional segment. So that's actually an offset. Okay, they might have raised more money actually than they spent in terms of capacity, but they increased their automation by 1 in the low end. The big one probably would have been going into their new product doom. Okay, and without looking at their annual report, I don't know that you guys could break that down what that actual cost was, but we know that they introduced a new product, and so that's going to have some cost in terms of the plant improvements, right? They got to build the plant, they got to add some automation, they got to add capacity, they got to do those types of things. So that probably was the big part of their cost. So
We get a question wrong in here, like we got 2 wrong, number 2 wrong.
yeah,
What does that do to our grade?
it lowers your grade.
Oh,
When you get questions wrong, yeah, you get a little lower grade as a result of that. So I'm usually pretty nice, and I kind of give you credit, so many credit points just for submitting your assignment and actually doing all the questions, and then I start subtracting from there. So it's usually 1.5 or 2 points per question, kind of. Okay, it might depend on how much work you showed me, what I see, those types of things. So, okay. So I try to be pretty consistent. Sometimes I'll weigh the questions, one a little stronger than the other. If a question's got 3 parts, and it's a little more difficult, it might get a little more weight. Okay, any other questions? See you tomorrow night at wrestling, 7 o'clock, gym. Armored gym.